Welcome to the Deep Dive. Today, we're really digging into Intel's Q3 2025 results, ticker INTC, of course.
Yep.
And we're going beyond, the surface level earnings chat.
Mm,
Our mission is to understand the big strategic shifts, these huge external investments, and the manufacturing story detailed in their report.
exactly. We're looking under the hood. And remember, when this report dropped, the stock was sitting at 37.775 cents. So the market is definitely sensing something big is happening.
Right.
Transition.
Right, lots of transition,
Uh-huh.
both internal stuff and these, massive external forces playing in.
Absolutely.
And the CEO, Lip Butan, his message was all about improved execution and steady progress. That was the phrase.
Okay.
But he really hammered home this idea that AI is accelerating demand for compute.
That's the key driver they're betting on.
Yeah, he framed the quarter less as just a financial bounce back and more like a strategic repositioning, setting themselves up to grab those AI opportunities across the board, ASICs, accelerators, even their foundry services.
So bottom line, they're trying to signal, hey, we're back, and they've got the cash and maybe a healthier operation to prove it.
Okay, let's unpack that healthier operation then in section one, because the Q3 numbers compared to last year are pretty dramatic.
Yeah, they are.
Revenue first, $13.7 billion. That's up 3% year over year, which, okay, it shows things are stabilizing a bit.
Stabilization is fine, but it's not the headline grabber here. The reversal is the real story. You got to look at the profit numbers to really get it.
Okay.
Q3 2024, they had that disastrous GAAP earnings per share loss, negative $3.88.
Oh, I remember that. Horrible.
This quarter, a complete swing, positive $0.90 GAAP EPS. That's like a 123% jump in earnings power.
Wow. So they didn't just, stop the bleeding. They actually figured out how to make money again pretty significantly using the standard accounting rules.
Exactly. And even if you look at the non-GAAP number, the one analysts often focus on, it was $0.23 profit. Compare that to a $0.46 loss the year before.
So the ship isn't just not sinking anymore. It's actually moving forward.
That's the picture they're painting. And the proof is really in the margins. That's where you see the internal correction.
Okay, tell me about the margins.
GAAP gross margin hit 38.2%. That's up 23.2 percentage points from last year. That is a huge improvement.
22 points. Okay, that speaks volumes about cost cutting or manufacturing getting better, right?
Both, probably. And look at the GAAP operating margin. It jumped 73.2 percentage points. Now, that reflects recovering from a massive loss position, but still 73 points.
That really confirms they're clawing back from whatever operational mess they were in before.
And that's what lets the CFO, David Zinsner, say the results were stronger than expected. And maybe more importantly, he flagged it as their fourth consecutive quarter of improved execution.
So they're building a case that this recovery isn't just a one-off, it's a trend.
They hope so.
But improvements like that often have a human cost, right?
Yeah.
We see that when we check the operational health. They did generate $2.5 billion in cash from operations, which sounds good.
It is a healthy number, but you have to look at the headcount figure alongside it.
Yeah.
The number of employees went from about 124,100 in September 2024 down to 88,400 by September 2025.
Okay, wait, that's a drop of nearly 36,000 people.
Well, they note about 3,300 of that is tied to the Altera deconsolidation we'll get to later. But yeah, you're looking at shedding roughly 35,000 roles in just 1 year.
35,000, that is a massive, massive restructuring. I mean, that level of reduction, it changes a company fundamentally. It shows just how aggressive they've been cutting costs.
Absolutely. You don't get a 73-point swing in operating margin without some pretty radical surgery, as you said.
Yeah.
They're betting that this leaner Intel, focused hard on manufacturing and high-end chips, can actually compete again.
Okay, which I guess leads us right into section 2, the partnerships and the money coming in. Because even with $13.7 billion in revenue, you don't fund a $100 billion U.S. expansion plan on your own.
Not easily, no. And this quarter was big for Intel positioning itself not just as a chip maker, but as like a key hub in the whole tech ecosystem.
Right. And the big headline grabber was that NVIDIA collaboration.
Definitely game-changing potential there. This isn't just some marketing fluff. They're talking joint development of custom silicon for data centers, PCs, hyperscale, enterprise, consumer, the whole range.
And the tech integration part is fascinating. They plan to merge Intel's CPU tech and the whole x86 ecosystem, which is still their bread and butter with NVIDIA's AI platforms, specifically using NVIDIA NVLink.
Right, NVLink. For listeners who track this stuff, that's the high-speed interconnect NVIDIA uses to link its own GPUs. So Intel integrating that is significant.
And it wasn't just a handshake deal. There was serious money involved.
Huge vote of confidence. NVIDIA agreed to invest $5.0 billion directly into Intel common stock.
$5 billion. Okay, that cements the partnership for sure, but doesn't that feel risky strategically?
Oh, so?
Intel's pushing hard on being an independent foundry, making chips for others. Isn't letting NVIDIA, a major competitor in many ways, get that close to your core by 86 tech via NVLink, giving away the crown jewels a bit?
It's definitely a calculated risk, a big one. It signals that right now in this AI arms race, speed and ecosystem integration might be more important than keeping everything proprietary.
So, pragmatism over purity.
You could say that. They need NVIDIA's AI platform dominance now. They seem willing to trade some IP access for that $5 billion and hopefully a bigger slice of the AI market. It feels almost like a wartime alliance.
Interesting way to put it. And the money didn't stop flowing there, did it?
Nope. SoftBank Group also jumped in with a $2.2 billion investment, another major tech investor putting skin in the game.
Okay, so $5 billion from NVIDIA, $2 billion from SoftBank.
And then there's the biggest and maybe most complex piece, the U.S. government funding.
Right, the TPPS Act money.
Intel announced the agreement for a massive $8.9 billion package tied directly to expanding advanced chip manufacturing here in the U.S., and crucially, they actually received $5.7 billion of that during Q3.
So this isn't just theoretical future money. It hit the books this quarter.
Correct. And it's explicitly about building up domestic capability. Geopolitics made manifest in cash flow.
So let's tally that up for a second. You've got $5 from NVIDIA, $2 from SoftBank, $5.07 from Uncle Sam, plus they mentioned getting $5.2 billion from cleaning up other assets, finishing the Altera deal, selling some Mobileye stake.
Right.
Intel isn't just running on sales right now. They're fundamentally reshaping their capital structure with these huge strategic injections, all aimed at funding what comes next.
Which takes us right to Section 3, manufacturing technology and that AI roadmap, because all this cash has to go somewhere tangible, into factories and silicon.
Yeah, that CEO quote about AI accelerating demand needs concrete proof.
Right.
What are we seeing on the ground, like on the factory floor?
The big news is Fab 52. That's their 5th high-volume fab down at the Ocotillo campus in Chandler, Arizona. It's now fully operational.
Fully operational. Okay, that's a major milestone for U.S. manufacturing.
It really is. And the significance is what it's making. Intel 18A wafers?
18A. The report called those the most advanced logic wafers developed and produced in the United States. That's a bold claim.
It is. And for you listening, 18A is basically Intel's answer to the cutting-edge stuff from TSMC and Samsung. Think they're 2-nanometer or sub-3 nanometer processes. Getting 18A running at volume is critical for them to reclaim leadership or at least parity in process technology.
So that $100 billion domestic investment they keep talking about, this is where it starts to become real.
Yeah.
Working factories making leading-edge chips.
Exactly. And they didn't just talk about the process tech. They gave previews of the products that will use 18A, specifically aimed at that AI demand.
Okay, like what?
Well, for PCs, the coming wave of AI PCs, they unveiled the architecture for the next-gen Core Ultra processors, Series 3, codenamed Panther Lake. That's about putting AI acceleration right onto your laptop.
Right, on-device AI. And for the big iron, the data centers driving the AI boom.
First, look at the next big server CPU, Intel Xeon 6 Plus Death, codenamed Clearwater Forest. They're promising significant power and performance gains. And in the data center, remember, power efficiency is just as crucial as raw speed, sometimes more so.
Got it. Any other specific AI hardware news?
Yeah, this was interesting, a new GPU announcement, Crescent Island. And they were very specific. This is an inference-optimized GPU.
Inference. So not for training the giant AI models, but for running them.
Exactly. For using the trained models in real time. That's aimed squarely at token clouds and enterprise inference workloads. It shows they're really focusing. Inference is arguably the faster-growing part of the AI hardware market right now, and Crescent Island is their play to grab a piece of that, competing directly with specialized chips from others.
Okay, so it really looks like a coherent strategy then. You get massive funding in Section 2, you get the advanced factory running in Section 3, and now you have the next-gen chips designed specifically for AI workloads coming out of that factory.
That's the plan, anyway. A vertical stack funded heavily from outside.
All right, now let's look at where the money actually came from operationally this quarter. Section 4, segment performance. That overall 3% revenue growth Where did it actually originate within Intel's divisions?
Yeah, the breakdown is revealing the strongest segment right now is actually the consumer side. Client Computing Group, CCG, was up 5% year over year, pulled in $8.5 billion.
So people are buying PCs again, maybe getting ready for those AI PCs.
Seems like it. That part is humming along okay.
But hang on, if AI demand is accelerating, like the CEO said, why do the big enterprise and manufacturing segments look kind of flat?
That's the interesting part. Data center and AI, DCAI, was actually slightly down 1% at $4.1 billion. And Intel Foundry was also down slightly, 2% at $4.2 billion.
Down. That feels like a disconnect with the AI narrative.
Ooh.
Why would the data center segment be down if AI is booming?
Well, a couple things. First, the real revenue impact of that AI boom might still be ramping up for Intel, specifically in the data center. It's stabilizing maybe, but not surging in their numbers yet. Second, there are structural changes clouding the picture. Like the Altera deal. They sold off a majority stake, 51% on Altera. That became effective in September. So Altera's results are now excluded moving forward.
Oh, okay. So that deconsolidation affects the comparisons in the outlook.
Exactly. And that structural change leads us straight into the Q4 guidance, which looks pretty weird at first glance. There's this odd split between their GAAP and non-GAAP forecasts.
Weird how? What are they projecting?
Okay, so for Q4 revenue, they're guiding $12.8 billion to $13.8 billion. Seems reasonable. But then GAAP EPS forecast, a loss of 14 cents per share.
A loss after swinging to profit in Q3.
Right, but then their non-GAAP EPS forecast for Q4 is a profit of 8 cents per share.
Okay, hold on. How can they project both a loss and a profit for the same quarter? What's making that huge difference?
It's the clearest sign that they're still deep in the middle of this transformation. Think of it like this. The non-GAAP profit shows the underlying business might be okay day to day, but the GAAP loss reflects the massive ongoing costs of the restructuring.
Like severance, closing facilities?
Exactly. Huge restructuring charges, stock-based compensation to keep key people during the turnaround. All that stuff gets stripped out for the non-GAAP view that management uses to gauge core operations. But the GAAP number shows the reality. Those transformation costs are still hitting the bottom line really hard.
Got it. So non-GAAP is the running the house view, GAAP is the rebuilding the house view.
That's a good way to put it. The rebuilding is still very expensive.
Okay, that makes sense. But the complexity here, especially with all that government money and the NVIDIA deal,
Yeah.
it does raise one more critical point, doesn't it? This brings us to Section 5, the big caveat.
Absolutely. This is important. The accounting treatment for those huge U.S. government transactions, particularly the CHIPS Act money and how they handle the related equity stuff, it's incredibly complex. Intel themselves admit in the report there's limited precedent for how to book this stuff.
Limited precedent? Okay, so what's the actual accounting question? What are they trying to figure out?
The core issue seems to be whether they can treat that CHPS funding primarily as something that reduces the cost of the assets they're building, which makes their balance sheet look stronger sooner and helps current profit, or if it has to be treated more like deferred revenue, recognized slowly over many years.
And that choice makes a big difference to the Q3 profit number they just reported.
Potentially a huge difference. So naturally, they went to the experts. They started consulting with the staff at the SEC to get their view on Intel's preferred accounting approach for Q3.
Makes sense. So what did the SEC say?
Well, that's the drama. They couldn't finish the consultation. Why? Because of the current U.S. government shutdown.
Wait, seriously? The government shutdown physically prevented them from getting accounting clarity from the SEC.
According to the report, yes, they were unable to conclude the discussion.
So let me make sure I understand this, and you, the listener, get this clearly. The impressive $1.90 GAAP profit that forms the basis of this comeback story. It rests on an accounting interpretation that hasn't been fully signed off by the regulators because the regulator's office was effectively closed.
That's the crux of the risk they disclosed. It's right there in the filing.
Yeah.
They explicitly warn that if the SEC staff, whenever they do conclude the review, disagrees with Intel's approach,
Then what?
then the Q3 2025 financial results we've just been discussing could be materially revised. They might have to recognize significant additional costs or losses for that quarter.
So the comeback narrative has a potential asterisk the size of a government shutdown hanging over it.
It does. The reported success is currently conditional on that accounting treatment holding up under SEC scrutiny.
That is quite something. Okay, so let's try to wrap this deep dive up. It was definitely a quarter showing major financial recovery signs for Intel, driven by some brutal restructuring, clearly, but also margin control.
Yeah.
They made really bold strategic bets on AI and bringing manufacturing back to the U.S., getting that 18A tech roadmap solidified. And they fueled it all with enormous amounts of external cash. The $5 ballers from NVIDIA, $2 ballers from SoftBank, and those billions from the U.S. government via the Cheeky PS Act.
Intel has definitely engineered a significant turnaround,
Yep.
both technically and financially on paper. But as we've seen, that success story is now tangled up with complex government policy, reliance on partner capital, and critically, these pending accounting decisions.
Which really leads us perfectly into our final thought for you, the listener, to consider. We saw the operational recovery, the tech innovation, the big partnerships. But arguably, the single biggest immediate risk factor hanging over their reported Q3 success wasn't market competition or a factory screw-up.
No, it was regulatory uncertainty, caused by politics completely outside Intel's control.
Exactly. So given how complex and absolutely material these U.S. government transactions are, what does this episode tell you about the critical role these sort of non-operating factors, things like government policy, like regulatory review cycles, even shutdowns, now play in shaping the success and the risk for even the world's biggest chip companies?
It really feels like the future of tech is becoming as dependent on the hallways in Washington, D.C. as it is on the clean rooms in Arizona or Oregon.
A sobering thought to end on. Thank you for joining us for this deep dive into Intel's very eventful quarter. We'll catch you next time.